Looking for strategies to help you protect your portfolio in these uncertain times? Visit robblack.com. robblack.com, powered by EP Wealth.
Early this morning, the stock market futures looked like it was going to be a positive open, but that quickly turned to red. The S&P 500 is down 1.2%, down 83 points. The Dow Jones Industrial Average down 1%, down 478. The NASDAQ down 1.8%, down 429. And the Russell 2000 down 1.3%, sitting at 2633. That's down 1.3%. Bitcoin is down 706, sitting at 66,181. Ethereum is down 28, down 1.4%, sitting at 1912. Bitcoin is moving lower when the stock market moves lower. 10-year Treasury sits at 4.1%. As we get deeper into 2026, expect the 10-year Treasury should move towards 4%, but not much lower. It's not looking like right now. It's going to take the bigger cuts probably in the back half of the year. Some big headlines out there. Lawmakers are targeting big tech's energy-guzzling data centers. I've got family on the East Coast, and my brother's daughter's big in Instagram. A lot of followers, and she's trashing Virginia's push into data centers, which is pushing electricity costs higher for residents, turning it into a story. U.S. existing home sales dropped to more than a 2-year low. That is a problem. There's a lot of problems on Wall Street. Have you ever figured this out? Like, McDonald's has to fight the GLP-1 fat drugs. And I only say fat drugs because Trump cracked me up when he said that. I'm not good with drug names myself, so call it the fat drugs versus the semaglutides is probably easier for me too. So the existing home sales dropped to a more than 2-year low in January. Home sales dropping 8.4%. Seasonally adjusted 3.9 million units. Economists were expecting to decline to about 4.1 million units. That's 200,000 units difference. Last month's sales likely reflected contracts were signed in November and December and would not have been impacted by winter storms that slammed large parts of the country in January. Inventory of existing homes fell 0.8% to 1.22 million. Supply was up 3.4% from a year ago, so it would take about 3.7 months to exhaust the current inventory of existing homes, up from 3.5 months a year ago. Typically, you want to see 6 months of inventory if you want to see prices dropping. 3 months really favors the owner of the home. Still, anytime someone sells a home, and this is you, this is me, this is anyone, right? We want as little to do with the process as possible. Get in, sign a realtor, tell them what they need to know, give them what they need to know, do the upgrades that they tell us to do, and then we want out of the whole situation. We don't want it to go on 6 to 9 months. That's when home prices fall, because it was priced incorrectly. Median existing home price last month rose almost 1%. Now sits at $396,800. That's the highest for any January on record. A lot going on. Tax refunds are coming. I'm going to work on my taxes this weekend. Never a fun time, in my opinion. Nor is the market right now. There is a very visible shift going on. And when I say shift, what I'm seeing is a rotation out of tech stocks and into stocks that will benefit the overall economy. Let's take a look at the year-to-date charts again, just to get a vibe for what's going on, what's working, what's not working. Crude oil, I told you it'd be up this year a lot. I called it probably the next big commodity push after gold, silver, and copper did their things. Now, crude oil has got a lot more fixed costs, so it's not going to be nearly as sexy. Speaking of sexy, though, crude oil right now sits at $69.69 a barrel. Ooh. If I were a younger man, I would insert joke there. Something about Diddy, oil, and the number 69. So Brent crude's up 14.7% year to date. Silver's up 16.4% year to date. Gold's up 17.8% year to date. Bitcoin's down 24%. Wow. Commodities are rocking it. The digital currency is collapsing. The S&P 500 is up 1.2%. The Dow is up 3.5%. So the S&P, which is heavily skewed by the Magnificent Seven and tech, is getting less than half the returns of the Dow Jones Industrial. Industrial is the key word, average. The NASDAQ overall is down 0.75%, in large part due to software companies getting hit due to the AI threat. But we're seeing that threat hit a lot of places. We're seeing it hit the housing market with realtors, investment advisors, insurance brokers, not just software. The fear of AI and what it's going to displace is real. Russell 2000, which should benefit from lower interest rates in the back half of the year, up 6.4%. And the Morgan Stanley Country Index All World is up 3.66. So in stocks, it's foreign stocks and small caps. In commodities, they're crushing gold, silver, and crude oil. They're getting 6 times the returns of the S&P 500, if not higher. Bitcoin is collapsing when it shouldn't. It should be holding its own, at least with stocks, is the expectation. The average Social Security monthly check for retired workers in the month of December was $2,071. Let's times that by 12 and say 24, 25, 26,000. Could you live off that? Pay taxes off that, pay healthcare off that, pay rent off that, eat food off that. That's why I do this show, because I could not live off that. Humbling to say the least. So today we're getting a mixed reaction to a sizable batch of earnings reports. Renewed weakness across mega cap and tech names. Broader market is mostly lower. Some defensive pockets are garnering rotational interest. Strength today in real estate, industrials, consumer staples, utilities, and healthcare. Things that we need. We need utilities for electricity and heat to cook. We need healthcare to stay alive. Consumer staples is also to stay alive, food. Industrials build out of the U.S. economy, build out of the infrastructure for AI. Real estate, lower interest rates should spark buying and selling. The Vanguard Mega Cap Growth ETF is down 1.5% today. Amazon's down 3%. A lot of pressure. When Amazon said they're going into the bond market, as did Alphabet, as did Oracle, the more the bonds they issue, to the tune of $1 trillion, then we're looking at IPOs coming out in the summer and fall. OpenAI, SpaceX, Anthropic, they should pull in $1 trillion of investor interest. Suddenly that $1 trillion sitting on the sidelines is starting to be used up. Or some of that will stay on the sidelines and move into diversified stocks or into real estate. But the debt issuance is an issue. I've told you I'll always be honest with you on AI. And I said I think it had clean sailing at least through the first 6 months of 2026. When I say clean, I don't think it's going to fall apart. But sometimes second half of 2026 to the start of 2028, I think there's going to be an action that's a reckoning. And that could be a big hyperscaler cutting down on CapEx. So far, that's not the case. It could be a big software company saying, we're just not getting the benefits out of this. It's not going downstream in any way, shape, or form. It could be that the IPO market disappoints with SpaceX, Anthropic, and OpenAI. A lot of debt's being issued now, and I think it is a race, and I think it is very strategic for Oracle and Alphabet. Alphabet issued that 100-year bond. I think it was very smart of them to raise the money now, because after the summer, a lot of money is going to be committed to some big tech companies that are brand new, fresh IPOs that are also some of the largest companies in the world. Which, again, I'm a little bit bummed about. Ideally, we live in a world where they would have come public a long time ago, and we would have been able to share the benefits other than private investors and venture capitalists and private equity. The public is getting no interest or very little interest from the benefit of SpaceX's huge market cap, OpenAI's, and Anthropic's. Cisco's down 11%. They've had a big run up. Revenue grew 9.7% year over year, which was above expectations. Guidance was solid and in line with expectation revenues. Cisco raised its 2026 outlook. It announced a small dividend increase, but rising memory prices are pressuring their gross margins. Cisco continues to execute very well operationally, particularly in networking, where AI infrastructure and next-generation campus products are driving meaningful acceleration in orders. The surge in AI-related demand, especially for Silicon One systems and optics, positions Cisco as a key beneficiary of hyperscaler spending in 2026. But the margin compression tied towards rising memory prices, it overshadows a rather solid quarter. And the memory prices are going to be a problem for companies like Dell, who I liked coming into the year until we saw memory prices continue to surge. I don't own any Dell, but I like the play on the AI data center. On the computers going more AI-oriented, but the memory prices, which we need in computers and servers, is problematic to gross margins. And on this show, I do love me the gross margins. So let's move into more of the day's headline news. DuPont, Honeywell, GE Vernova, and Eaton have all been on a tear. They're all industrial stocks tied towards AI data centers. JP Morgan hiked its price target on DuPont to $57 from $50 after the earnings report earlier this week. A little bit more color on what analysts had to say about Cisco. Not just me. You want to hear what the analysts say. I get it. William Blair said on the margin front, Cisco guided a contraction in non-generally accepted accounting principle margins to 66% in the third quarter. That's down 150 basis points sequentially. That's the elevated memory price inflation. Barclays said the revenue outlook has improved and AI orders accelerated. They're not seeing enough translation to earnings per share growth, particularly given the gross margin concerns that recently popped up and memory prices. Citi said Cisco indicated that memory prices increases hit the company with zero lead time. That said, the company is working to add more flexibility around their terms and conditions framework in order to pass along memory price increases faster. So everyone's saying it. It's going to be a theme that resonates. It's one of the problems hitting the AI trade right now. The bond market is hitting it, raising cash before the big OpenAI and Anthropic can. A lot of people think that once a company becomes public, that the venture capitalists, the private equity, the insiders have squeezed as much as they can really squeeze out of it. It's a pain in the ass to be a publicly traded company as an executive. You have to give guidance. You have to live close to that guidance. You have smaller windows to sell your stock. It costs a fortune to be a publicly traded company. Samsung said it's begun mass production of its next generation high bandwidth memory offering known as HBM4. It's shipped commercial products to customers. That's good news for the AI computing market because that market needs as much high bandwidth memory as they can get. Meta Platforms is breaking ground on that new data center in Indianapolis. I talked about that yesterday. More than $10 billion will deliver 1 gigawatt of compute capacity. Meta says its 2026 capex will be between 115 and 135 billion. Spending is robust. Again, we still have time on the growthiest part of the hyper investment theme of AI. American Electric Power reported better than expected results. It's an Ohio-based utility. They're benefiting from high electricity demand. They signed a 28 gigawatt of load capacity agreements since October. Wow. In order to secure all that gigawatts of electricity, a lot of gas turbine capacity is coming online for companies like GE Vernova and Caterpillar. Citi upped its price target on Home Depot to $450 from $407. They have a buy rating on the stock that implies 15% upside. They think the housing market will become a meaningful tailwind for Home Depot in the back half of 2026 with lower interest rates. Citi upped its price target on McDonald's to $375 from $371, with analysts believing that share gains will accelerate following strong results. What's interesting to note about McDonald's is they set a dubious record. They became the largest seller of socks in the world for one day. McDonald's Grinch campaign delivered McDonald's highest single sales day in history and briefly made it the world's largest seller of socks, because when you bought a Grinch-themed Happy Meal, you also got Grinch socks thrown in, and it was a viral hook. I've got a great show planned for you today. I got some of the economics on dog shows. I know you're saying that's not what I was looking for from you. I've got more on drug companies like Viking Therapeutics and Paycom as finances. What's that telling us about our job market? I got information on Waymo and their new vehicles, some of the new engineering and testing and why they're doing it. I've got some information on Apple, as well as some technicals on the markets. Other people's words, not mine, because I'm not a technician per se. We could talk about the AI shift of what industries are going to get hit, but also why so much money continues to go in at the top end of the funnel, whereas the software, which is more the middle end, isn't necessarily acting like it's going to be a big winner. It's a little unfair to say. I know that. Beyond the Noise, Navigating Wealth in Uncertain Times, big event March 11th, 6:30 to 8:30, Lafayette Library with Stephanie Richmond and Nathan Rogers. It's a great event in the evening, 6:30 to 8:30. A lot of easy parking in Lafayette, a lot of great restaurants. I'll probably get there around 5. It is in the middle of rush hour, which is less than ideal, but Wednesday, March 11th, 6:30 to 8:30, I'll get there around 5. So you take off a little early from work, come meet me, talk financial planning, talk investment advising. But on top of it, it's an in-person event. It's hard to know what matters the most in retirement and what's tune out as far as wealth preservation, retirement planning goes. It's the Dan Totson Community Hall at Lafayette Library. Sign up at robblackshow.com. That's robblackshow.com. More show coming up right after the break.
You are listening to the Rob Black Show podcast. For more information on EP Wealth, visit robblack.com. That's robblack.com.
So it's now about 12:30 East Coast time, 9:30 West Coast time. S&P 500 down 72 points, down 1%. The morning has gotten a little bit uglier, but it's not that bad. We're close to pretty much so close to all-time highs. The Dow Jones Industrial Average 30 is sitting down 496 points, down 1%. NASDAQ's down 1.4%. Obviously, the big loser is the Russell 2000, down 2.1%. Very thinly traded, so it moves in big chunks. New York Fed report this morning is saying that Americans pay for almost all of Trump's tariffs. It's still, that's pending the Supreme Court and tariffs and the rebuke or no rebuke. Do we pay it back? Do we not? What's happening with Canada and Mexico? I don't like it. I don't think free trade should be completely free and frictionless, but the United States is a wealthy consumer, and it would be nice to see us move past tariffs and into lowering our cost of living with goods being made overseas, which again is controversial. Nike wouldn't have had the stock move that it had from the 1990s into the 2000s. I know that's a little bit past performance, is it not? It is. But Nike wouldn't have had that run if it wasn't for lower cost labor in other countries. Which means your running shoes that are $120 probably would have been more like $125, $200, $150. But the lower cost of labor kept that cost down, which is something you and I think appreciated over time. Got used to it, and tariffs have upset that apple cart, if you will. Bad Bunny's halftime show showed you everything that you need to know about the decline in linear television. 127.2 million Americans watched it on TV, but 4 billion views on social media in the first 24 hours after the performance. Obviously, YouTube's a big winner. Apple's a big winner for sponsoring it. But Instagram and TikTok also. The song Only Thing More Powerful Than Hate Is Love got 179 million views on Instagram. Instagram, on one clip, got 50 million more eyeballs than television did. How much did Instagram have to pay for that? 0.0. Probably some server costs. But it's the most viewed NFL social post ever. In America, we had 61.5 million dogs in 2001. Today we have 87.3 million dogs. That's a 42% increase. Average lifespan is about 12 to 14 years, thus roughly $2,500 a year, which is conservative. 87.3 million dogs. We're spending $218 billion per year on the dog. Now, the dog just had their Super Bowl as well. I know you're saying, please don't talk about the Westminster Dog Show. Oh, I'm going to do it. In large part because I have to. I strangely enjoy cooking and looking at the dogs prance around. I have a kitchen that overlooks a television. 2.5 thousand or 2,500 canines, 212 breeds. They all go to the Westminster Dog Show, the Super Bowl of dogs. A Doberman Pinscher named Penny just won, and it was a pretty good looking dog. Not like I'm going to say, boy, I got to go get me a Doberman Pinscher, but some kids will. It's a small fortune that goes into the breeding, the grooming, the training, the feeding, and the showing of prospective prize winners. 29,000 events per year. I hear it's a great job for the lower income people in the United States. Those families could send their kids to the American Kennel Association, and they'll train them how to be dog handlers. And you can get $500 to $1,500 per event just prancing dogs around stage. But back to the Westminster Dog Show. You have to go through a series of events to get your dog ranked. And there's 29,000 events in the United States every year. To enter into one of the shows, it's $3,500 to $100 a pop. To get your dog ranked and followed and people cheering for it at said dog shows, you spend over $200 to $2,000 on a photo shoot and put your dog in the trade magazines. You have to do the travel costs, the boarding, the grooming. Winners get a ribbon, which I'm pretty sure the dog is pretty unaware of. They also get a crystal trophy, not that valuable. No large cash prize. Now here's where the money comes in. Stud fees. $5,000 to $25,000 per breeding. Puppies of winners go for about $3,000 each for pure breeds. That's not uncommon. What do you think about the economics of dog shows? I'm going to let that one sit for a couple minutes with you before you actually answer and yell at me. Do not answer and do not yell at me. So I ended with talking about McDonald's. Price target going up to $375 in the last segment. Analysts believe the share gains will accelerate following strong fourth quarter results. Talked about the Grimace and the sock sales for McDonald's, largest sock seller in the world for one day when they introduced the Grimace socks. But restaurant brands shares gained 1.3% following the Burger King parent's beat on the top and bottom lines. So people are starting to come back to restaurants, whether it's the value meal or the Burger King. The value meal at McDonald's or the Burger King revenues. This bodes well for Chipotle stock. You can take a look at it. If you want to be more conservative, you would look at a McDonald's, because I just told you the price target goes to $375. Take a look at its current price in the low 300s. I think Chipotle is also on to the same kind of vein, that the revenues are coming back in. The tax refunds are going out soon. The jobs number is concerning because the job market for the middle income and lower income of America is not as robust as the job market for the upper leg K wealthy people. QuantumScape down 10%, company's latest financial results. They developed solid-state lithium metal battery technology. They lost 17 cents a share. An EBITDA loss of $250 million for the full year. That's a lot of money. It expects capital expenditures for the year to be $40 million. The kicker is it's no revenue. If their technology hits, it's a home run. If it doesn't, the company struggles. I ask a question, and I think this is pretty fair to ask. I know they're losing $250 million, and that's a lot of R&D. But could another company be doing similar technologies? Now, I know QuantumScape had a big investor in Bill Gates. I don't know if that's still true, but I know at one point in time he was talking up the technology. His investment firm, his family office, basically got him into it. I don't know if he endorsed it per se, but how do you feel about the home run or the strikeout investment? As I got older, I got wiser, and it's less and less for me. I'm not saying no. Anheuser-Busch InBev, they make awful beer. Their fourth quarter earnings topped expectations, sending shares 2.6% higher. I don't know if I'd own beer right now with millennials, Generation Z, Generation Alpha. They're just not drinking as much alcohol. A, it's expensive, and they could be falling into that lower income, middle income group who only has so much money to go so far, and they're trying to get housing, whether it's rent or buy. They're trying to get food with food costs going higher. Where does beer fall in? Viking Therapeutics jumped 16%. They announced plans to advance its oral obesity drug into phase 3 development. That'll compete with Eli Lilly and others. Novo Nordisk. That's a big jump. Small company. We're getting a lot of fat drugs, GLP drugs. And it's a good thing. I don't think it's a bad thing. I think it's a great thing for society. We'll live longer, and that brings up questions of how much you're saving. But I think it is a good thing. AppLovin down 7%. They reported earnings that were special. The company's already down 32% for the year. It's not... AppLovin's one of those companies that a lot of people think are going to go lower, a lot lower. Therefore, I don't play it. To me, it's too much of a civil war. And a lot like divorce, no one wins in divorce. No one wins in a civil war. Brothers killing brothers. Magnum ice cream. Ooh. It was spun off from Unilever. Reported revenues that missed expectations due to a weaker than expected growth in sales, maybe due to GLP-1s. I don't know. I don't follow Magnum ice cream. Keep talking about memory storage stocks and their ongoing rally. Shares of SanDisk and Seagate up 6% and 3% each. Micron and Western Digital up 3%. When Cisco says bad news about their memory cost hurting their results, that's good news for SanDisk, Seagate, Micron, and Western Digital. Waymo CEO Takindra Maukana says she thinks the company could reach 1 million weekly paid autonomous rides this year. That would be more than double the roughly 400,000 rides that the subsidiary is currently providing after quadrupling service in 2025. Company plans to get there by adding new vehicle models to its fleet and expanding in additional markets like Washington, Detroit, Las Vegas, San Diego, and Denver. They currently operate in 6+ cities. They've expanded into Miami in January. They've got more than 2,000 fully driverless vehicles on the road. Waymo, obviously a division of Alphabet, which is the parent company of Google. So Alphabet owns Google, and they also own Waymo as product, as businesses. It's fascinating to think that the company that was Google now owns 2,000 driverless vehicles. The search engine company is also a taxi cab company. Taxi cab that has no humans in it, yet still a taxi cab. Tesla says it's operating about 500 robotaxis, which for the most part have human drivers in 2 markets, Austin and San Francisco Bay Area. I don't even think they have 500 robotaxis, to be fair with you. So, of note, and I'm not bashing Tesla when I say that, I'm just talking the truth. Waymo is beginning deploying its next generation Ojai robotaxis to extend its U.S. lead. This is story number 2 on Waymo this morning. It's 6th generation Ojai robotaxis. They're providing driverless rides for employees and their guests in San Francisco and LA right now. 6th generation driverless system means costs are coming down. And usability and power is going up. That's the beautiful thing about tech, smaller, cheaper, faster. By upgrading their driverless technology, adding more vehicles to its fleet, they're going to extend their lead. They're going to lock in loyal riders. The Alphabet-owned company said its sixth-generation Waymo driver uses more cost-effective parts and should be able to navigate through harsher weather conditions than previous generations. The new system is going to serve as the primary engine for the next era of expansion, so says one of the vice presidents at Waymo. The deployment of the next-generation robotaxi comes as the company pushes to extend that lead. They expect to hit international markets like London later this year. There is rivals, including Amazon-owned Zoox and Tesla, with robotaxis. Chinese robotaxi companies include Baidu-owned Apollo Go and WeRide. They've been expanding abroad at a faster clip than Waymo, so the United States is behind in this market. The global market for driverless ride-hailing has significant potential, likely worth more than $25 billion by 2030. I love the idea. My in-laws came to visit for the Super Bowl, and it scares the pee out of me every time I see him drive away, because when you're 87 years old, your reflexes aren't what they were as a younger man. Mine aren't the same in my mid-50s as they were as a younger man. I gingerly walk down a flight of stairs now because I've got size 14 feet. Both my kids have size 14. My youngest one, he's already at 14, so I think he's going to get up to size 16. That's crazy. What am I making over here? Like Frankenstein boys? Anyway, back to Waymo in China. Waymo's decision to use Chinese electric vehicles in its U.S. fleet has raised GOP lawmakers' concerns. They've locked in a race with China, but it seems like you're getting in bed with China. So says Senator Bernie Moreno, representative out of Ohio, who's a Republican. I'm actually okay with some cross-pollination between countries. I think we're all on this planet for a very limited amount of time, and the more we share our resources and our technology, I think the better. Waymo will not provide any access to its closely held autonomous driving technology sensor data, nor any rider information to Zeekr. Zeekr is one of those companies that is tied towards Chinese robotaxis. It's a subsidiary of Geely. It's responsible for providing base vehicles, and Waymo installs its autonomous driving vehicle technology in the cars in the United States. Waymo's sixth-generation systems will also work with robotaxis built on the Hyundai Ioniq 5, which is a much cheaper vehicle than the Jaguar I-Pace vehicles. You might be familiar with Jaguar I-Pace fifth-generation systems. Waymo said, "We've consistently operated mixed fleets for years, including when we transitioned from fourth-generation drivers to the Pacifica to the fifth-generation driver on the I-Pace. The Ojai is a boxier ride with a lower step and higher ceiling than Waymo's existing robotaxis. It's got about the same footprint. The higher ceiling makes it a little bit easier to put a smaller, I guess you would call that a radar, on top of the car. The reason it's on top of the car because it needs to see above your car and in front of the car in front of it. Alphabet has some other bets, and they refer to it as other bets. When they released their earnings reports, they lost $7.5 billion in 2025, up from $4.4 billion in 2024. Waymo has raised $16 billion in funding, led by Alphabet, valued the company at $126 billion. I would expect they're going to be a 2027 IPO, if not late 2026. Its next generation i7 megapixel imager. It's going to be a breakthrough in automotive vision technology. It's going to allow the system to see around the vehicle with fewer cameras. New in-house algorithms help improve performance in rain or snow. Right now, their sixth-generation LiDAR leverages the significant cost reductions that the industry has seen over the last 5 years, especially as affordable LiDAR increasingly appears in consumer vehicles. Pretty fun times to be living, in my opinion. Apple's smartphone market share is growing in China after staging a comeback last year as consumers flocked to the iPhone 17. The U.S. company continues to gain ground in China. That should help get their stock to the $300 to $325 level that a lot of analysts have for it for this year. The iPhones accounted for 19% of all cell phones sold in China in January, up from 14% a year earlier. That's a lot of cell phones. Now, yesterday, late afternoon, you probably didn't hear it on this show in the morning, but in the afternoon show you heard about it. Apple took a hit late afternoon on a report that it's pushing back its AI Siri features again. In the end, I still use my iPhone every day, and even though I bought it a year and a half ago thinking, oh, it's going to be the first AI-powered phone, it hasn't been. Google gets that crown. Ooh, in the last year, I'm supposed to be getting some of those AI features? Nope. They weren't ready. Apple has said, we're putting up the white flag and we're going to start using Google's Gemini in our phone, but it's still not ready for March operating system update. That's going to be spread over future versions. That means some features first announced in June of 2024. That Siri would be able to tap into personal data and on-screen content. They might not arrive until September when iOS 27 comes out. Now, again, it was embarrassing what they showed us at their, I refer to it as a back-to-school fall event back in 2024. And what they showed us was a lie. It was fabricated. They made it look like the phone could do it, but it was craftily edited video. A festive meal based on a mean, green, hairy creature fueled McDonald's biggest day ever. The Grinch helped set new sales records. It didn't just steal Christmas, but it stole McDonald's. I don't know, it didn't steal, it helped. For the 3 months ending the year, the chain's same-store sales grew 5.7%, exceeding expectations of 3.9%. With a Grinch meal, you got a drink, you got an entree, Big Mac or 10-piece nuggets, you got a special fries seasoned with dill-flavored Grinch salt, which sounds disgusting to me. It shows you how product and marketing really work in investing. I think the bulls have taken control amid new AI spending and expanding breadth of the market. So as we get into 2026, we are starting to see some challenges for insurance companies, for investment advisors, for other industries like the legal profession, billable hours. AI is going to be able to do a lot of the work. For investment advisors, they're seeing a new tax module being introduced to some of the competitors. Thus, the values of companies like LPL and Charles Schwab are dropping almost 20%. For insurance brokers and investment advisors, the onboarding of a client, a lot of that information can be done with AI agents. Ultimately, I see lower fees for the investment advisor world, for the brokerage world, and I think that's good for you. And I think that's where AI earns some of their money from the big investments into AI data centers. And the companies like Amazon, who could do a web service, Microsoft, who could do an Azure web service, Google, who could do the web services as well, they benefit because they're selling those services to companies that are selling software packages now to the investment advisory world, to the insurance world, to the lawyer world. It's not going to stop. You're going to see that uptick. And I think the narrative is back into the hands of this CapEx is going to continue to swell through 2026. Will 2027 be higher than 2026? I doubt it, because these numbers have gotten bigger, faster. Could it be? As we get more into sovereigns and universities and other business models picking up their own large language models that are unique to themselves versus being more universal commodities. I think seasonality is suggesting the February lows are close to end now on the NASDAQ. Can I promise you that we don't go lower, that a rotation doesn't continue? I can't. I think as we get closer to NVIDIA's quarterly earnings, that should help, because NVIDIA is the king of the jungle, so to speak here. Now, competing with AI is a stronger economy, and that's where the Russell 2000 small caps is shining right now. The S&P 400 mid caps are shining. The Dow Jones Industrial Average is shining, outperforming the S&P 500 weighted index of tech companies, the Magnificent Seven, beating the NASDAQ as well. But I do think the February lows are in or close to in. I'm not a market bottom caller. In the bigger part of the economy, trucking rates are soaring. Trucking spot rates are up to 61 cents a mile over the past 4 months. Such strength is highly unusual for February. It's typically one of the slowest months of the year. The truckload index signals a robust underlying economy. So throw that in with this recent quarter's earnings from AI, where Oracle, Alphabet, Amazon, Meta, and Microsoft all are increasing their capex. We have a robust U.S. economy. We've got AI spending, plus we have trucking. People are consuming in the United States. AI spending now accounts for more than 2% of GDP, more than what was spent on the railroads in the 1850s. AI-related capex spending was already huge, and now companies are telling us it's going to be even bigger. So I'm okay buying Microsoft, Meta, Alphabet, and Amazon on dips. A little bit more speculative on Oracle and Microsoft as they have AI software plays tied towards them. If you really want to get speculative, though, you're starting to look at the Cipher Mining, ticker symbol CIFR, IREN, ticker symbol IREN, Astera Labs, ALAB, TeraWulf, ticker symbol WULF, Nebius Group, ticker symbol NBIS. I am not into that kind of risk. I don't need small companies that have just incredible swings that I don't think are going to be relevant 10 years from now. So keep in mind, I think one of the big fights right now, which gives you an opportunity to get into certain AI-related stocks, whether it be the infrastructure or the semiconductors, maybe it's the software companies, but in the last 2 weeks, since February 6th, it's been a software apocalypse. Anthropic showed just a little bit of the Claude AI chatbot and how they were adding legal tools to its co-work assistant that could track compliance and review legal docs. The result after they showed this pretty cool module was an 11% sell-off across 3 days for the iShares Expanded Tech Software Sector ETF. People were surprised at how well Anthropic handles enterprise software. And then a couple days later, February 9th, insurance brokers got hit. An AI tool from an online insurance shopping platform called Insurify caused a 4% drop in the S&P 500 insurance index, the biggest drop since October. Wealth managers took it on the chin on February 10th, earlier this week, when a company called Altruist launched a new AI-powered tax planning tool, Schwab and Raymond James Financial LPL. They were the collateral damage, falling 7 to 20% over those 2 to 3 days. Then February 11th, yesterday, there was no specific AI tool that served as a smoking gun, but the likes of CBRE Group, commercial real estate group, and Cushman & Wakefield said they saw losses of more than 10% on speculation the industry's vulnerable. One Wall Street analyst attributed the selling to investors fleeing high-fee, labor-intensive businesses. Wow. This has been a week. It's been a full-on movement. It's tough to know what's next. Hypersensitive stock market, and it is a hypersensitive stock market at times. We're going to see companies and engineers roll out these tools. Some of the big tech firms are going to be rolling them out. Some of the big tech firms are going to be buying the players who obviously are winners going forward. Craziest thing that I saw yesterday was the Vatican Bank has launched U.S. and Eurozone indices filled with stocks that align with Catholic values. So would you want to invest like a Catholic? If you're Catholic, the answer is absolutely. Maybe. I was raised Catholic, and I've invested in some things that would be considered non-Catholic. My father died of cancer, and I didn't have a problem owning Philip Morris. The Vatican Bank did not share its criteria for selecting stocks that align with the Catholic social teaching. It's interesting when backtested over a decade, the portfolio, which consists of 50 stocks each, have posted impressive gains. The U.S. index has returned 18% per year on average over the last 10 years, while the European index has returned an average of 10.2%. So the Catholic Church has rolled out 2 indices, one based in Europe and one based in the United States. Now, some of these names instantly made me think, why is that Catholic? And I'm not trying to start a fight with anyone, but if anyone can tell me why Meta is considered part of Catholic social uprising, It's one of the largest holdings, followed by Amazon, Nvidia, Tesla, Apple, JP Morgan, Broadcom, Visa, Micron, and Alphabet. That's in the U.S. And the holdings all range from 5.3% in Amazon down to 2.8% in Alphabet. The top holdings for the European index include, we'll start from the bottom up, Allianz, it's an insurance company, UniCredit, Vinci, Prosus, Banco Bilbao, Argentina, Hermes, Banco Santander, Deutsche Telekom, and ASM Lithography. Again, I'm not really quite sure what makes those so Catholic-oriented. It's a damn fine question. It'll have to be answered later. Coming up, I got the afternoon show. The afternoon show has got mostly new content. Big event coming up March 11th, 6:30 to 8:30 at the Lafayette Library, Beyond the Noise, Navigating Wealth in Uncertain Times. It is one of my last two events. It's one of only two events also. That is a seminar. It's an evening, 6:30 to 8:30 at the Lafayette Library. Stephanie Richmond and Nathan Rogers are going to be presenting, as well as I am. I'd love to see you there. Sign up for the event at robblackshow.com. That's robblackshow.com. Don't forget, afternoon podcast, New Focus on Wealth. Where you find podcast, look up New Focus on Wealth, and you'll find me or Chad there. Sign up for the event at robblackshow.com. Sign up for the podcast where you get podcasts.
Visit The Rob Black Show online at robblackshow.com. Listen to archived podcasts, market updates, and information from EP Wealth's certified financial planners online at robblackshow.com.